Okay, now I want to talk about the income statement and the balance sheet. Remember I said a corporation is a money machine, right? So in order to know if that machine's working right, I need to look under the hood and see what's going on. I do that with the financial statements. And the first two financial statements I'm going to look at are the income statement and the balance sheet. The income statement here tells me the money that I've made for the last year, and note this is, we have these 12/31/2013, so this is going to tell me the money I made in 2013, and maybe not exactly the money I made is the right way to say it, but you'll see a little bit better as we go forward. The balance sheet tells me what I have and what I owe. So that's also a snapshot. This is what I have and what I owe as of December 31st, 2013. Alright, so let's take a look at a couple of the details here, and we'll start first with the income statement. Alright, the bottom line, this net income number, is not an actual cash flow. That's one of the important things I want you to think about. The net income I have here is not an actual cash flow. That's kind of the flaw, not really a flaw, but it's the weakness maybe of the income statement. So first I have sales, and we're going to keep this as simple as we can. You know, you can have sales that are on credit or sales for cash. We're not going to get into that too much. Then we have cost of goods sold, and cost of goods sold is the material that you're buying. You subtract that, so this is $70,000 minus this amount. That gives you your gross profit. Operating expenses, and all of these definitions are in your book, but I just want you to think big picture here. The book will give you a little more precision. Operating expenses are management salaries, lease for the building, those type of things. And depreciation sometimes is put in as an operating expense, sometimes it's not, so we have it broken out. Depreciation expense, and that's not something I actually write a check for, so this one's kind of important. This depreciation expense is only there because the government allows me to take that to reduce the total tax burden that I have. So if I buy a piece of equipment, gross fixed asset, so if I buy a fixed asset, I get to depreciate that over time. You need to think back to your accounting course. You get to depreciate that over time. In this class we're only going to use straight line depreciation, and that's going to reduce my total income that I show the government, and it's going to make my taxes a little cheaper. Alright, so I subtract from gross profit, I subtract operating expenses, depreciation, I get operating profit, and then I have an interest expense. Where does that interest expense come from? Well, I have long-term debt, and I have notes payable here. It's zero, but I could have notes payable, I could have long-term debt, or the current portion of long-term debt. I'll describe that in just a minute. But whatever money that I owe my debt holders, remember the money the debt holders have put in from that first video, I pay them interest, and that interest expense I get to is a cost, so I write that check. So my earnings, the EBT here is earnings before tax. So my earnings before tax are the operating profit minus the interest expense. Now notice here I'm subtracting my interest expense before I come up with my taxable income. This earnings before tax is my taxable income, so I subtract that interest expense first. That's going to come to play later on in the semester. So I show the government that I've earned $21,000. I show these guys I've earned $21,000, and now I pay a certain percentage on that $21,000 to come up with my $8,400. If it weren't for this depreciation amount, it would be $24,000, and this $8,400 would be bigger. So my net income here is $12,600. So that is what appears to be the money that I've made in 2013. Alright, so let's look at what I have and what I owe. On this side, these are my total assets, and over here are my total liabilities and equity. These always match. This 161 and this 161, they have to balance. They have to balance because this is a balance sheet. So I could block out some number in here and you'd be able to figure out that number because it would be a plug figure. And I know it's not exactly clear right now, but I'll show you that a little bit later on. Couple of interesting things, or maybe more than a couple interesting things here. First, these three, cash, accounts receivable, and inventory, those are your current assets. They're called current assets because I can turn them into cash quickly. Obviously cash is cash, so I mean I don't have to turn that into cash. But accounts receivable, That's what people owe me. So I've sold something on credit. I need to pay that. I need to receive that a little bit later. Okay, sorry for a brief interruption. Accounts receivable is money that I am owed because I've sold people my goods and services on credit. Inventory is it's easier for me to visualize something about a car dealer. Inventory is the cars on the lot. If I have a clothing store, inventory is the clothes that I have. A furniture store is the furniture in the showroom. Alright, add that up. Those are current assets because I can sell these things off pretty quickly and turn them into cash. You see liquidation sales because they're going to turn inventory into something liquid, which is cash. Cash is considered to be liquid. Alright, so these next things, this is going to be important. You're not required to report gross fixed assets and accumulated depreciation. So that doesn't have to be there. I've shown it in this one, but it doesn't have to be there. All that firms are required to report are the net fixed assets. So gross fixed assets is what you spent for plant, property, and equipment, right? Gross fixed assets. You may see the term plant, property, and equipment, and that's the total amount of money you spent for that. Accumulated depreciation is the depreciation from the income statement that's accumulated over the year. So in other words, since we had depreciation of $3,000 in 2013, and our accumulated depreciation is $4,000, next year our accumulated depreciation is going to be $7,000. So this accumulated depreciation keeps going up, keeps accumulating over time. So in 2014, it will be $7,000. Alright, let me get rid of that real quick because it's just going to be in the way. And then we have the net fixed assets. You add that $76,000 of the net fixed assets to the $85,000 of the current assets, and you get that $161,000. Over here, the current liabilities, this is going to be the flip side of the current assets coin. Alright, so notes payable, here it shows a 0, but I could have this notes payable, think bank loans. In this class we're not going to be real technical. You can see this is bank loans or something someplace else, but notes payable, short-term debt. I have to pay this back within a year. Accounts payable, I've bought something on credit from a supplier and I owe them that money. That supplier would see it as accounts receivable, just like I have accounts receivable with somebody that I'm supplying or somebody I'm loaning stuff to, or I'm selling stuff to on credit. Accruals, think about accruals just as salary paid, not salary paid, excuse me, salary to be paid. I haven't paid them yet, but I owe my employees that. Current portion of long-term debt, I want you to think of it like this. I have long-term debt, which is more than a year. So eventually, as time goes by, long-term debt becomes short-term debt, right? So this line, which is a 0 here, but that's fine. This line means, was there debt that I issued years ago that now I have to pay within the year? So those are all my current liabilities. And I want to know the current liabilities versus the current assets, because current liabilities I have to pay in a year. Current assets, I will get that stuff back relatively quickly. So I got to make sure I'm not going bankrupt. If I have more current assets than I have current liabilities, I'm probably not going bankrupt. It's huge, right? Long-term debt, these are the bondholders that put in money for a long term. Preferred stock is slightly different than common stock. Read the definition of your book. It's not important right now, but just look that up in the book. Common stock, and this common stock, by the way, can be split into common stock at par and additional paid-in capital, or capital surplus, either one of those terms. So that $47,000 may be split two different ways. But anyway, that's your total common stock. And then the $1,000 retained earnings. So you remember I had the dividend decision, right? I could either pay money out as a dividend or I could keep it as retained earnings, and that's the retained earnings number. So importantly, this $12,600 either goes out as a dividend or stays in as retained earnings, one of the two. And that will be important a little bit later on. We don't have to deal with that right now. Alright, so let me change colors here so you can just see this. This common stock and this retained earnings, this is going to be my total equity in the firm. Preferred stock is a hybrid between debt and equity. I want to think of the common stock, it could be split up to common stock at par and additional paid-in capital, and retained earnings. Think of those two together as the equity I have in the firm. Alright, so let me show you one more thing here, and that'll be it. We can do what's called a common size income statement or common size balance sheet. So make sure you look at that in your book quickly. All that's doing is for a common size income statement, I want to put all these numbers in percentages. I want to have all these numbers in percentages. So I will have, for the income statement, I'll have everything over sales. So whatever I have, I'll have cost of goods sold over sales, gross profit over sales, operating, all that over sales, and all this will be over total assets. I'll have cash over total assets, accounts receivable over total assets, inventory over total assets, all those. Then the reason I want to do that is it allows me to look at the a large firm and a small firm and see percentage-wise who has the most in expense, who has the most in cash, who has the most in whatever different of those assets, pound for pound, inch for inch, kind of in a percentage-wise basis. And I can compare small firm versus big firm, and also I can look across time at my own firm and see, as we grow over time, do our operating expenses grow as a percent of sales, or do they go down as a percent of sales? So that will allow me to look at the firm and say, hey, this money machine is running well, this money machine is not running well. But in order to do that at the intro level, I really need to just go through the nuts and bolts and memorize how to do an income statement and a balance sheet. So if nothing else, you just got to go through here, and if I give you any of these components, you got to memorize this. I mean, that's all there is to it. You just got to memorize the order these things come in and the logic behind them. Alright, so that's it for this video.